Okay, everybody, we're going to go ahead and get started. I know we still have people that are kind of filtering into the webinar, but I thought I'd go ahead and just do the housekeeping while we're here at the beginning still. So our webinar will be recorded and a link will be sent to you next week along with a copy of the slide deck and any of the relevant handouts and links. For questions, this is really important. Please post your questions in the Q&A box, not the chat box. The Q&A box creates a log, and so what happens is that if there's any questions that we're unable to answer at the end of the presentation or during the presentation, then we get that log and then we can kind of reach out to you directly and try to follow up with you if you have a question that was not addressed. And speaking of questions, make sure to keep the questions very general in nature. You know, you want to be careful about saying, I got, IRS letter 6173, I'm so-and-so. Don't try not to be super specific about your situation. General questions are going to be the best. If there's detailed or specific questions, we can always have a discussion afterwards. And then due to the amount of attendees in the webinar, we'll be keeping all mics on mute and video off. So again, try to filter everything through the Q&A chat box, or the Q&A box, not the chat box. Thanks, and I hope you guys enjoy the Crypto 201 presentation. Okay, so getting started today, we have myself, Mishkin Santa. I'm the International Tax Director here at the Wolf Group. There's a little bit of my background. I'm sure you guys all know me by now, but luckily today I am joined by one of our tax managers, Fan Chen. She is awesome. As you can see, she does a lot more for the organization than I do. She has a fantastic background. She's been with us for quite some time now. Master's of Accounting from American University here in DC, and she is going to be taking up our crypto practice as the practice leader, hopefully in the near future. So she's going to be speaking today on a couple slides and giving her thoughts and commentary on various crypto issues. This is the 201 presentation. So if you have questions about the 101 presentation or you're uncertain kind of as to what was presented in the 101, that's on our YouTube website, on our YouTube channel. You can find the 101 presentation. And basically in the 101 presentation, it gave like the facts and background of crypto, where did crypto start? What was the timeline? What are some basic issues about crypto, character of income, taxation, things like that, just giving general background of cryptocurrency. This is a more in-depth presentation kind of going on to advanced topics of cryptocurrency. So the first thing I want to bring up is that there are about 4,000 cryptocurrencies in circulation, and that number varies depending on who you talk to, and at any given time, there could be between 4,000 to 5,000, but as of right now, let's just assume there's about 4,000 different types of cryptocurrency. The estimated market value on the slide says $1 trillion, but again, depending on who you talk to, it could be more than that. So for example, the IRS Commissioner, Chuck Rettig, said that he believes the value of crypto in circulation is about $2 trillion. And that was, I believe, testimony he gave in April to Congress. So again, that will also fluctuate depending on the value of crypto, and we'll take a look at that here in a minute. But out of the $1 trillion or $2 trillion of value, Bitcoin pretty much has half the value there. So they're half the market cap, which means that they are the king of the hill. Bitcoin is also the founder of the feast. They're the first coin, if you will. So it's no wonder that they have 50% of the market cap. And then about 26% of all crypto asset founders are going to be located in the United States. So that's just a couple stats to consider when you're thinking about the market of crypto right now. One thing that I think is very important, and this was actually addressed in the presentation I did yesterday to the DC bar, but it's the impact of cryptocurrency and the value of Bitcoin during the pandemic and kind of the usage and general acceptance of cryptocurrency in the marketplace. I think as the pandemic kind of went on, starting roughly March 2020 through where we're at today, we're seeing more people kind of getting into the crypto, including cryptocurrency as part of their portfolio. Could it have been sheer boredom? People couldn't leave and they were quarantined in their home. We saw a lot of people investing and trading in the stock market more than ever before. We are seeing the same kind of trend with cryptocurrency. Again, the general usage and acceptance of cryptocurrency, in my opinion, has been accelerated significantly by the pandemic. And in turn, the more that certain cryptos are used, the more value that they're going to have. So you can see from this slide that in April of 2020, the value of Bitcoin is a little bit less than $10,000. And we get into the late winter 2020, early 2021, and you can just see these massive spikes in the value of crypto and value of Bitcoin. And at one point, I believe it got up to about $63,000 a coin. So that's a lot. That's a big value, and that's a big amount of usage of the Bitcoin recently. So keep that in mind as we go. That's a theme that we're going to be presenting throughout the presentation that I want everyone to keep in mind. Another thing to keep in mind is Ethereum. I didn't really talk about Ethereum too much in the first presentation, but a lot of people believe that Ethereum at some point will replace Bitcoin, because Bitcoin basically is just a medium, a cryptocurrency for money, or the exchange of money for services or goods, or exchanging other cryptos. Ethereum is a little bit different. It really works with what we call smart contracts or self-executing contracts. And a lot of things are starting to be on the Ethereum network, or being Ethereum-based coins or tokens. Ethereum was created in 2014 by the individual on this slide, Vitalik Buterin, and he basically wanted a different type of cryptocurrency to be on the marketplace that had a little bit more functionality than Bitcoin. And so the first Ethereum coin was released in 2015 as part of Frontier, but we're seeing the usage of Ethereum more and more these days, and we'll talk a little bit more about that here in a minute. Okay, non-fungible tokens, NFTs, that's what they call these. On the left, you have the Michaela Maroney not impressed from the Olympics a couple of years back. On the right, you have the Lionel Messi, which is one of first of several different types of NFTs that he'll be putting out later this year. But basically what's happening is we're seeing a lot of athletes use the NFT platform to really get their images and likenesses out for sale. And so they're capturing certain events or certain images in a way that is almost like a collectible, right? And so the whole point of an NFT is that it's rare, it's scarce. So if you're able to purchase one of these, not very many people are meant to have them, and so they're worth a certain amount of value. And again, the whole purpose of it is to capture an event or something that you can kind of put into a picture of some sort or a digital image. And so another example of this would be Fanatics and Candy Digital. So Fanatics is the biggest shareholder of Candy Digital, and they're basically coming out with two NFTs. The one on the right is they're taking a picture of the Los Angeles Dodgers championship ring from the World Series last year, and that's going to be put out as an NFT very soon. And then on the right is the famous Lou Gehrig speech, and that is going to be a baseball card NFT that's coming out very soon. So as you can see, this space is expanding, and if you think about it, we now have the college athletes that can sell their names, images, and likenesses. Would it be possible that later this year we see the Alabama quarterback or the Ohio State quarterback have a play where it's captured in an NFT that they're selling to make money? The NFT is going to touch a lot of different areas, not just art, music, and celebrities. It can drill down to a lot of different areas. So it's a big industry now. And we'll go into that on this slide. We see that NFTs have been around since 2014. Again, they're meant to capture, one-of-a-kind items that have limited runs. The first big NFT came from an artist named Beeple. And Beeple was doing a lot of NFTs and put together an NFT called The First 5,000 Days. And that was sold at Christie's for $69.3 million. So that's a huge amount. And then on the right-hand side of the slide, we see, Lionel Messi basically talking about, his viewpoint of the NFT, which is another way for him to connect with fans. And so he's teaming up with Boss Logic and Ethernet to put out his series of 4 NFTs, again, over the rest of the calendar year. For anyone that knows me, I'm a huge Yankees fan, and Don Mattingly is my favorite player of all time. I love that baseball card, the 1988 Topps baseball card. I was shocked to learn that Topps has basically lost their contract with Major League Baseball, and it's been sold to Fanatics. And so Fanatics is basically, they've never published a baseball card ever, put one out. You're basically taking over as the main vendor for baseball cards after the Topps contract expires. And as we just saw, Fanatics is teaming up with Candy Digital. They're putting out the NFTs. So the real question here in my mind is, will NFTs replace tangible baseball cards at some point in time? Will there be different classes of NFTs? NFTs that are rare and one of a kind, and then NFTs that are maybe a little bit more commonplace. Are we going to see the end of a paper tangible baseball card that you would collect? Would that make those cards worth more over time? You can't find them anymore. You can't get them anymore. So these are things that are brand new to our society, and kind of figuring out how they will work is going to be very, very interesting. NFT sales, and again, just huge growth in this area. So in 2020, we saw there's about $93 million of NFT sales. And so far, through about halfway through the year, right after Independence Day, we're at about 2.5 billion. So just massive growth in this area. And again, a lot of this is going to be collectibles. In some cases, like if you see the slide on the right, there's art, there's games, but a lot of it's going to be in the collectible arena. So a quick comparison of an NFT versus cryptocurrency. What makes the two different? Well, an NFT is non-fungible, right? I can't trade an NFT that has Trevor Lawrence for an NFT that has Saquon Barkley. Two different artists will come up with that, or two different creators. It'll have different properties. One could be, an image from the draft. One could be an image from a touchdown. They're not going to be something that can be traded one for the other. Whereas cryptocurrency is fungible. You can normally trade one crypto for another. You can do exchanges. And we'll talk about like-kind exchanges here in a little bit, but that's typically going to be the difference between an NFT and cryptocurrency. Okay. So how does the NFT process work? And I've never created an NFT or purchased an NFT. So forgive me if I'm saying something incorrect here, but this is my understanding of how it works. There's a primary market where you have a creator that creates or mints a token or an NFT, and then what they do, almost kind of like a normal artist, right? So an artist, creates a painting or creates an NFT, they put it on a marketplace platform for sale. The NFT as a digital asset is held on the Ethereum blockchain. That's why I talked about Ethereum earlier, because Ethereum is the only place you could really hold that right now. It's one of the primary places you would hold that at, okay? An investor would then come across and buy that NFT. That investor could then turn around and sell it on the secondary market, okay? And so this is where perhaps I would come into play, right? So someone creates a Don Mattingly NFT. I want to buy it. So someone has purchased that from the original creator. I'm now going on to the secondary market to purchase it from that person. And they're saying, hey, you got to have Ether to be able to purchase that. So maybe now I have to go from US dollars to Bitcoin to Ether and then purchase my NFT that I'm adding to my collection and my portfolio. And so within that whole schematic, you have various layers of tax transactions that are occurring. So for the creator, from what I understand and what from a lot of practitioners believe, we're getting into the collectible realm, right? So we're getting into Internal Revenue Code 408. I'm not 100% certain 408 is going to really apply here. And I think that this is an area that, I know Congress is super concerned with Internal Revenue Code 6045 and 6050 right now, which we'll talk about. But these are areas that I would love to see Congress maybe modify or add some context to, especially for NFTs. I mean, 2.5 billion market share at this point in time. I don't think that's anything to sneeze at. I think it's definitely something that Congress should address to, how this would be taxed. But let's assume it falls under 408. What you're going to have here is you're going to have a self-employed individual, more likely than not, unless they create a business. They're going to file a Schedule C. They're going to pay self-employment tax. And they're going to use the Form 8995 if it's a qualified business income deduction, which may or may not apply. I mean, there could be a good argument that's a specified service trade or business, or maybe not, right? And then most folks are doing this from home, so maybe they also get the home office deduction, and that's the Form 8829. So theoretically, this is how the creator from the NFT would report their income and how it would come out and be taxed, right? The seller on the secondary market that say is selling me the Don Mattingly NFT per se, right? These are going to be short turnaround times. So they're going to buy it off the creator. They're going to turn around and try to sell it very quickly, more likely than not. So you're going to have an ordinary income event. Basically you're going to hold the asset for a very short time. It's going to be a capital asset. If they did hold it for a long period of time, though, it could be a long-term capital gain. And typically you're going to report that on Schedule D and Form 8949. And then the collectible capital gains tax rate may apply, right, to 28% as opposed to the 20%. Also, the net investment income tax would likely apply too. So now you have an additional 3.8% to consider on top of that. Again, I'm just giving you what I think would play out there. I'm not 100% certain that that's actually would be true in the long run, but that's, if someone came to me today and said, hey, I have this transaction, how would I report it? Then that's how I would go about doing it. And then NFTs, I think, we're talking a lot about collectibles and art and areas like that. But from a practical standpoint, it's been told to me that one area that people are super excited about is NFTs for real estate. Because it's basically a self-executing contract, you can check chain of ownership, you can do title reports, it's easy to track things. There's no ability to manipulate anything in there. So, there's been talk that this could be practically used to make real estate transactions easier, more verifiable, perhaps do contracts for exchange of real estate. And as an attorney, the downside to that, I think, is would you litigate that? If someone really had a dispute on that, could you litigate a self-executing contract or a smart contract? And what is the future of that? I think that's an area that, will be developed within the law very soon, hopefully. And now I'm going to turn it over to my colleague, Fan, and she's going to talk about mining.
Thank you, Michigan. So for mining, if you remember from Michigan's first presentation, that's where a miner used their computer to solve complicated math problems to verify transactions on the blockchain. And as a reward, they receive cryptocurrency. So this active validation is considered a trade or business for tax purposes. Your recognized income using the fair market value as of the date of the receipt of the token mined. At the same time, you'll be able to deduct any business expenses like your hardware, maybe depreciation of your equipment. If you work from home, you may be qualified for a home office deduction. And if your mining operation is in the US, you may be qualified for qualified business income deduction. Of course, you'll file the Schedule SE as all other self-employed people here to report self-employment tax. We want to pay attention if you are a miner that's located offshore. In terms of self-employment tax, you may want to look into the tax totalization agreement between the US and other countries. So for IRS to treat your activity as an active trade or business, it needs to be consistent, continuous, and the purpose of the activity should be to make a profit. So some miners have smaller operations, may not be making a profit. They're just dabbling in this area. You want to be careful with the hobby loss rules. For those incidences, if your mining income is considered a hobby income, you have to pick up your whole income as ordinary income, and you won't be allowed any mining deductions or expenses to reduce your income recognized. Say if you hire a miner as an employee for your mining business, you will then have to pay a wage income to your employee. Depending on your agreement with your employee, whether it's a cash payment agreed upon as a wage, or we see more often the employee would receive the token mined, and then the wage income you would report would be the fair market value as of the date of the receipt for the token mined. And for employee, just like all other employees, you'll have to file federal and state withholding, and you'll be subject to other payroll taxes. So this is the easy part where we're more familiar with, like self-employment tax and payroll tax. Next, we're going to get into the pool mining. This is where multiple miners pull their resources together so they create a better processing and they can produce a better mining output. The miners generally pay a fee to the pool, and the miners will receive their proportionate tokens from the total pool they earned. In this structure, where there are multiple miners working together, The IRS may argue that you created a de facto partnership or joint venture. If that's the case, the mining pool will have to be subject to the partnership tax rules, have to file partnership returns, the Form 1065, and have to issue Schedule K1 to each partner every year. Now it gets very interesting and maybe messy. What if you have one of the miners overseas? What if there's a non-resident miner? Then the mining pool will be subject to a lot of different withholding requirement, a lot of different forms you'll have to file with the IRS. And the non-resident miner will be required to obtain an ITIN, the individual tax identification number from the US government. On the reverse, if you are a US miner joined a foreign mining pool, if you own, say, more than 10% of the mining pool, then you may have to file foreign partnership form 8865. You may have to report your interest in the mining pool on the form 8938. There's an even more complicated structure here that's called cloud mining. Instead of owning your own hardware, you're renting the hardware from a data center that's in the cloud. The data center would disperse the expenses to their investors. The tax structure is a little bit different, but then say if you are a non-resident investor, invest in a US data center for cloud mining, how does the income works here? From a US tax perspective, if you are a non-resident person, you will be subject to US income tax for effectively connected income with US trade or business. Now you're investing in the cloud mining, what you receive as income is virtual asset. Does that construct effective connected income for US tax purposes? For another reiteration, what if the foreign company uses a US data center for cloud mining? Does the foreign company has effective connected income? Will that make the foreign company have a permanent establishment here in the US? Will the foreign company then have to start filing US tax returns? These are all the current issues that we identify, and we don't have a clear answer from the IRS. So I have to keep a close eye out on further guidance from the IRS. Now I'm going to turn it back to Michigan to talk about staking.
Thanks, Van. Very informative on mining. Okay, staking. So it's my understanding that staking is like the eco-friendly version of mining. It uses a lot less power and a lot less utilities. So if you listen to the first presentation, the 101, one of the big concerns about mining is that it just soaks up a ton of power, a ton of energy. Your utility bills are through the roof. Whereas staking, there's less that has to be done there. Some people argue it's almost like a passive activity. You just kind of set your program and forget it. Again, I've never seen anyone do staking, but from what I understand, you're validating the minting of a new token. So you're basically helping a token come into being. And when you do that, if you do enough of the attestation work, you do get a reward for doing that. But it's my understanding that you kind of have to pledge some of your own collateral or tokens to even get there. So it's a little uncertain as to what doing a proof of stake work or staking really is. It's not like mining where you're solving an algorithm and you're getting a coin and you're investing into it through that process. It's a little bit different of a process that we have going on. And one thing that we're keeping a super close eye on is the Jarrett versus United States case. This is a big deal because this case will tell us what the courts are thinking staking actually is. It will help us understand how they're classifying the income and how it should be reported, even if it is income, which we don't know. But in this case, we have Mr. Jarrett basically did staking, helped bring Tezos coins into being. And he declared the income, he paid tax on it, and then he filed a refund claim to get the tax paid back. And basically he's arguing that his staking work is similar to that of a baker or a writer. I'm not sure that those arguments in the end are going to be the best ones for him. I think when you read kind of the commentary on the case, there are probably different arguments that could and should be made. But it's definitely a case to look at very closely. Do we have a true accession to wealth here? or is there not really an event that's occurring that is a wealth inclusion event? So we'll pay close attention to the Jarrett case. ICOs, IEOs, and STOs. I know that's a lot of acronyms back to back to back, but we're in the tax world and that's what we do. We do acronyms. ICOs and IEOs and STOs were huge back in 2017. I mean, it just took off. People were all into it. A lot of different tokens were being issued and being made. A lot of these were out of Switzerland. We saw a lot of US owners that had CFCs, and basically the way that we were classifying that income was subpart F for 17 and guilty for 2018. So a lot of unknowns though with ICOs and IEOs and STOs. I mean, this is another area just like NFTs and staking that we're trying to put our arms around and make sure we understand how these transactions will work. But ICOs really have gotten a bad name. If you listen to what the IRS says, there are a lot of fraud schemes that occur with ICOs. Estimates have about 60% of the ICOs in 2020 were all fraudulently based. And these have been banned in some countries altogether, like they don't even allow them, nor do some of the social media websites allow ICOs to be published or have their kind of materials put out there for general consumption by the public. But ICOs, like I said, were huge at one point in time, and they've kind of faded to the background. This is a little chart, though, of kind of the ICOs and the number of millions of dollars that are currently being put out there. And you can see that, the US definitely leads the pack, but we have Singapore and Russia kind of, number 2 and 3 back to back there. Okay, the meat and potatoes, I think, of this presentation is what I'm about to get into. And remember, I talked about the themes of, more general usage due to the pandemic. And this is another theme that I'm going to raise here, which is, how do we get to the legislation that we're at to today? And the first foray, or the first shot across the bow, came from a Treasury proposal. It's like listed as draft when you read it, that came out on May 14th, 2021. And in that Treasury proposal, it basically brought up 3 different sections of the Internal Revenue Code that the Treasury would love to see changed or updated by Congress. So we have 6045, 6050, and 6038. And so let's go through these one at a time. And so one of the first things they want to do is they want to define what they call reportable virtual currency. And so within their proposal, they're giving this like elongated definition of this is what we think reportable virtual currency should mean. And this is what we think it should be kind of classified as, a substitute for currency. I highlighted that because, again, we're going to talk about themes that are currently happening right now. Okay. An intermediary, which is a broker, these are people that were subject to 6045 reporting, would then be defined on this slide here. So we're seeing that an intermediary means a person that is in charge of overseeing an acquisition, disposition, or other transfer of reportable virtual currency. So these are very broad definitions of broker and reportable virtual currency. And then the last one, which I think is super, super interesting, is the Treasury would love to see all reportable virtual currency as a foreign financial asset. And if you look at the last sentence there, it says, it's tricky and likely gameable to determine what's foreign and what's domestic. I've had people come to me before and say, hey, we think we need to report this on the Form 8938. And then you're kind of doing this like crazy research project to determine where's the server that the crypto is located on for the exchange, where the wallet's at. I mean, it can be a nightmare trying to say yes or no, this is foreign virtual currency. So basically what Treasury is saying here is any reportable virtual currency, whether it's in the US or abroad, would be considered a foreign financial asset. And then that would have to be reported on the Form 8938 should the value in combination with other assets exceed the Form 8938 threshold. So that's a huge change. That's a huge change to 6038D. That's a huge change to how we think about virtual currency. And that would trigger, in my opinion, a lot more Form 8938 reporting. And maybe they would even, do a secondary Form 8938, like a Form 8938, dash A or something, or C for virtual currency or whatever it is. But I think that if this proposal right here kind of gets into one of the bills and is required, it would be a drastic change that a lot of people with just US holdings probably would not be aware of or understand how to do. Okay, so the next shot across the bow is, I think about 2 weeks later, the Green Book comes out. And the Green Book is normally going to be an illustration of what the White House wants to see passed. So in the Green Book, we see that they're very much big about expanding and instituting broker requirements onto crypto exchanges and custodians. We're also seeing that they would love to see a crypto FBAR. And so for those that may not be familiar with an FBAR is the report of foreign bank accounts. So if you have 10,000 in the aggregate, $10,000 or more of foreign financial assets offshore, you report those on the FBAR. Well, here you would have an FBAR for crypto. So if in the aggregate you had more than $10,000 for crypto assets, you would then report that on the crypto FBAR. And if you think about that, let's say that you have a couple different cryptos that maybe are very low in value, and maybe they spike for 10 minutes, 15 minutes and get really high. It's very easy to exceed that $10,000 threshold with cryptocurrency and crypto investments. I mean, it could literally happen over the course of a couple minutes or a couple days and then drop back down. So you could have a couple crypto assets that maybe are much less than $10,000 that at one point in time or another exceed the $10,000 limit. So interesting aspects of how you would even administer that or enforce that. The Green Book also goes into a lot of ways that they're trying to gain information from enhanced broker reporting. There's kind of a stress within the Green Book that they want to see business entities that may be masking the true owners, foreign owners, folks that are invested in the US that maybe are not reporting what they need to be reporting, or using intermediaries or shields to break up the beneficial ownership requirements. They also want to see the broker report the gross proceeds or the end product. And that to me is a little tricky, because if you give someone a 1099 and it's basically incomplete, like there's no cost basis on there, or perhaps crypto transactions occur over multiple wallets and the 1099 only captures a segment of that transaction, like maybe just in wallet 2, but not wallet 1 or wallet 3. I think that you have an incomplete chain of events. And then really there could be a lot of mismatching, especially within the IRS systems, of what's presented versus what actually comes out to be on a tax return. So, one thing to notice is at the top of these slides, they're saying that these proposals would be effective as of January 1, 2023. They want to give people as much time as possible for technology to catch up and these things to be instituted properly. But I'm not even sure by Jan 1, 2023 that could be done, logistically speaking. I think that's a Herculean effort. I think maybe by 2025 something like that could be put into place that would be effective, but I think there'd be a lot of kinks that would have to be worked out for this type of reporting to make it work properly. Okay, fast forward to August, so where we're at right now, and we have the IIJA, and as I'm kind of like the naysayer here, because I keep telling all of our staff, at some point we're all going to have to learn 3 different tax codes: the pre-TCJA, TCJA, and the IIJA, or whatever the new tax reconciliation bill is going to be. But the IIJA, or the infrastructure bill, basically had a couple provisions for tax in it, and again, mostly relating to cryptocurrency. And so within that bill, and this is a little smudgy, so I do apologize, I kind of snipped it right out of legislation, but they, instead of using the term reportable virtual currency, they're going to use the term digital asset. This is the Senate. So the Senate says, we don't like the term reportable virtual currency. We like the term digital asset, and we're going to define it. And as you can see, their definition is a lot shorter than the Treasury definition of what reportable virtual currency is, okay? They're also going to say that brokers, so this is 6D45, brokers would need to report covered securities for digital assets. So that's basically what they're classifying the transactions as, covered securities. So does that raise SEC implications with this bill, okay? And it says any broker, so that's really broad. And it talks about accounts that are maintained and shall make a return, which means file a 1099 or some version of 1099, okay? And then the thing that I think is super interesting, we look at 6050 and look at the beginning of the law there. It says treatment as cash. As the first time that we see in any law that the US government is saying cryptocurrency will be treated as cash. That's a big deal. And basically saying any digital asset for purposes of that section is treated as cash. So we're moving more towards cryptocurrency being treated equivalent to cash unless as personal property. This obviously is not going to do the trick. It's not going to, make it all cash on a go-forward basis if passed, but it's at least a good step forward to making it not personal property, which in my opinion is an inefficient way to do it. All in all, what happened is that the end result of that is now with the House. I think the House has agreed in principle that they're okay with the bill and they're going to put some meat and potatoes on it. However, several senators got together and they wrote this Dear Colleague letter. And it's been told to me that if you rewind back to say 2015, 2016, there was maybe one crypto lobbyist. We, here in 2021, there's like 50 to 60 lobbyists now. So now you're seeing on the right-hand side of the slide, all these different senators who probably had nothing to say about crypto in the past. Now they've all got something to say about crypto. They all are trying to push, the interests of their lobbyists. Basically saying like, look, the definition of any broker in the 60/45, the broad sweep that you're trying to change for 60/45 is just going to give you crazy. And you're basically taking a decentralized system and trying to make it centralized because you're putting a lot of the requirements that banks and brokerages do in our centralized banking system into a very decentralized. The whole purpose of, the cryptocurrency and the blockchain is decentralization. And so you're creating middlemen where middlemen shouldn't be at. And it's going to be a very, very tough go under the way that you've written this legislation. And you're going to probably drive a lot of these folks outside the US. So it'll be a huge loss of revenue at some point in time. So can we either redefine this section or create exceptions to this section? I think they very much want it to be in the congressional language and not leave it up to the regulations as interpreted by the IRS. So that's where I think the Dear Colleague letter is coming from. And that's where we kind of leave off that. And we'll watch closely as events unfold. I'm going to hand it back to my colleague, Fan here, who's going to go through private letter rulings and some other areas of cryptocurrency.
Thank you, Michigan. Private letter rulings are written decisions by the IRS in response to taxpayers' request for guidance. Generally, it's applied on a very specific transaction. So the IRS has openly said that they're willing to explore the use of private letter rulings to address cryptocurrency-related questions. Cryptocurrency matters are not straightforward. What we see now is that we're applying the Internal Revenue Code of 1986 to a new area. The benefit of private letter ruling is that the decision is binding between the IRS and the requesting taxpayer. Have to keep in mind that the ruling may not be relied on as precedent by other taxpayers. One thing to know is that private letter ruling requests can be very expensive. The request itself may cost from $3,000 to $30,000. And you might want to work with a qualified tax attorney. You may want to hire a CPA to work on the request. That being said, if you have very complicated transactions and you have the resources, private letter rulings can be a very good option for you, assuming the IRS take on the request, take on the case. So treaties are bilateral agreements between two countries to address the double taxation issues. The US currently has 58 income tax treaties. There are talks about amending the existing ones and negotiating new ones. However, there has been no new treaties for the US and other countries since 2009. What does it mean? That there's no treaties that mention cryptocurrency. You can't find the tax treatment reportable regarding cryptocurrency anywhere in the treaties. Here, we can see different countries classify cryptocurrency as a different type of asset. For a tax treaty to apply, under a tax treaty, a resident of a foreign country may benefit from a reduced tax rate or exempt income tax on certain types of income. As we see here, if different countries are classifying cryptocurrency as a different type of asset, a different type of income, then there's a mismatch in foreign tax credit and there's no tax treaty basically you can apply to such income. To give you a really quick example here, if you sell a cryptocurrency in South Korea, it's treated as a sale of domestic asset in South Korea. The income is classified as other income. And other income is taxed as your ordinary income, in a different tax bucket. Say if you're a US person, from a US perspective, your sale of cryptocurrency is a capital gain, it's a passive income versus an ordinary income. Now you see here, there's a mismatch in foreign tax credit. So what I'm trying to get here is that the ways to mitigate double taxation that normally you would get for other types of income just simply does not exist. I mean, they're not available in the current tax treaties. Some countries are ahead of the curve. The UK HMRC put out this crypto assets manual, an online manual, a very interactive website describing the definitions of different types of cryptocurrency transactions, tax events, and how the UK treats different type of cryptocurrency assets. I highly encourage everyone to take a look just to see how other countries define things and how they're taxed in the other country. Very similar to the US, the Australian Tax Authority, ATO, is matching data from cryptocurrency service providers to individual tax returns. Last year, they issued 100,000 letters to taxpayers with cryptocurrency assets. Australia, the ATO, is a member of the J5. J5 has Canada, Netherlands, US, UK. They share resources and they share their information with each other to catch people who are evading tax around the world. And they're a really powerful group. So if I am a US person with a lot of Australian ties, I'd be really careful here because the ATO will share my information with the IRS. This is very interesting. So the El Salvador government voted to have Bitcoin to become legal tender, which is going to be effective really soon, right after Labor Day, September 7th. This is a big deal. I think El Salvador is the first country that adopted Bitcoin as legal tender. This would definitely encourage other countries to review their definitions, their laws and regulations towards cryptocurrencies. As we see very common in the Central American countries, there are a lot of distrust in the government. So we see a tendency of more and more countries follow El Salvador's steps and make Bitcoin a legal tender. I can see this create potential problems for cross-border transactions. How is it going to be regulated if one country uses dollar and the other country uses a cryptocurrency? Here are some examples for indirect investment in cryptocurrency. These are various mechanisms that the financial institutions are using cryptocurrency to diversify their portfolio. Earlier this year, Choice and Compass Mining started offering their clients the Bitcoin mining as part of their IRA portfolio. Just like all the other income you earn in your IRA, the tax is deferred. The Bitcoin mining income is tax deferred if it's an IRA. It's a very interesting and growing area. We'll definitely keep an eye out for the opportunities out there and how they will be taxed down the road. Another thing we see more and more often is crypto loans. Crypto loans are very similar to a regular loan. The difference here is you use cryptocurrency as a collateral. Generally speaking, you can use up to 50% of your crypto asset, and there's no requirement for credit checks. The loan has to be made at arm's length. Most tax practitioners right now would view this crypto loan, the whole process as without any tax transactions throughout the whole process. Say, from you putting your cryptocurrency into the collateral, you get the cash as a loan, you pay it back, and you get your cryptocurrency back. There's no taxable event here. But say if you don't pay it back, the IRS could reclassify the whole process, the loan, as a sale of crypto assets. They will look at the substance over form, and they may say your multiple step of the loan process is like one step, and they may tax you on the gain from this one step process. For non-resident aliens, we see this very, very often here at the Wolf Group. We have a lot of clients who are A1 diplomats, G4 international organization employees. Because of their special visa statuses, the substantial presence test rule does not apply to that, which means they're not considered a US tax resident, although they live in the US. One internal revenue code that's often overlooked is the section 871, which says if you are a non-resident, if you're anyone physically present in the US for 183 days or more during a calendar year, your net capital gain is subject to a 30% flat tax rate if you're a non-resident here. So a lot of A1, G4 diplomats or international organization people open US brokerage account. They were asked to submit the form W9, which would be incorrect. That's the form for US residents. The correct form for them to fill out is WABEN. We see this problem very, very common for very regular, very common stocks and securities, and now we're throwing the cryptocurrency into the mix. And a lot of our clients don't even realize that their cryptocurrency investment here in the US are taxable at a 30% very punitive capital gain tax rate. And if you look at the 1040 NR, which is non-resident income tax return, on the front page, you will see that there's a question asking you whether you've had any transactions in cryptocurrency during the calendar year, and you have to check yes or no to complete your tax return. Now I'm going to turn it back to Michigan again to finish up the presentation with the current US effort.
Okay, guys, so great info there from Fan, a couple tidbits to be careful with and know about. I'm going to go a little quicker here towards the end, just run through a couple of things that people should be aware of. This is the scary stuff, right? This is the IRS enforcement. I drew a line, or the best I could draw. I think maybe my 5-year-old could probably draw better than that. But basically, if you see here, it says the IRS is not contemplating a voluntary disclosure program to address non-tax compliance issues involving virtual currency. This is an LBI active campaign for virtual currency, which they publish all these active campaigns on the IRS website. This to me was thinking that occurred back in maybe 2018, 2019. The folks that were really getting into cryptocurrency or virtual currency at that time, the IRS just didn't feel like they had the profile that they would actively or voluntarily come forward like a lot of the folks did with the offshore voluntary disclosure program in Switzerland and in Israel and India and those places. They just weren't the type of people that would actively do it. I think that they really need to go back and re-look at this and rethink this, because as the pandemic has shown us, there's more general usage of cryptocurrency now. And it's my take that the folks I'm seeing want to do it right. They want to, they know maybe they're in non-compliance and they want to find a way to do it correctly, but they don't want to have to get into a COVEL agreement and pay a bunch of attorney's fees. And, the juice has got to be worth the squeeze, but if you have to go into a similar type of, engagement where you were doing the offshore voluntary disclosure program or voluntary disclosure, I mean, that could be very, very costly and not really worth, the time and effort and energy to put into it. So I think that there should be a more structured amnesty program or path to compliance for people that are perhaps out of compliance with cryptocurrency. Okay, the 10,000 letters. So we saw that Australia did 100,000 letters. The US, we did 10,000. We were kind of the founders of the feast there. That was in 2019. There's basically three different types of letters that were sent out. The 6173 letter is the "you are in serious trouble" letter. That's the one where you probably want to go out and get an attorney, just because there could be some criminal issues there. The attorney should go get a COVEL letter for their CPA and make sure that everything's reported correctly. The 6174 and 6174A are not as harsh. I'm not sure if it's necessary to really go out and get an attorney, but you do want to make sure to kind of look at your filings and make sure that everything has been reported correctly and properly. And if you do need to make amendments or corrections, then you probably want to respond to those letters and get them done. A lot of these cases have yet to be resolved, mainly due to the pandemic. I think that's really slowed everything down. But I think that due to the lack of IRS workforce and the time it's going to take for them to rebuild based on their new budget, this may actually take a while for us to fully resolve and get some information on. So still a danger zone, in my opinion, if you have one of these 3 letters floating around and attached to you. Chain analysis, they're like the darling of the US government. I mean, they're making contracts with every single FBI, ICE, IRS. I mean, look at all the contracting agencies on the right-hand side of the slide there: Air Force, CFTC, DEA. So they're winning all sorts of contracts. They're tracking the crypto. When things are happening and you're kind of wondering, like, how do they get that crypto back? Someone creates a fraudulent scheme on somebody. It's chain analysis is probably the one that's tracking it and figuring it out. So, when people say, well, how will they know? That this is how they will know. There's organizations like this that are really getting in the mix and helping those government agencies to figure out where the crypto is at. The IRS is also using, or the Department of Justice is using summonses, John Doe summonses, to get information about US taxpayers. They did this with foreign financial assets. They're now doing it with cryptocurrency. So we see here in 2016, the first one was on Coinbase. And then earlier this year, we see in April that there's a summons on Circle, and then there's one on Kraken. So they're really saying, look, we're seeing different exchanges that are not doing things correctly, and or we're seeing people participating in these exchanges that aren't doing things correctly. We want the records, and we may send out another 10,000 letters, or maybe even 100,000 letters, right, to the individual taxpayers that are not reporting information correctly. The IRS is touting their enforcement. They're saying, hey, look, we're coming in strong. We've got all these great cases that we've worked on, that we've been able to solve and track cryptocurrency and prosecute people criminally. And so you can see here, there's, they got some folks in the dark net who laundered over $300 million using cryptocurrency. So Larry Harmon out of Akron, Ohio was the one that was doing it. They caught him doing it. He'd been doing it for a long period of time. And, it's one of those things where they're saying, hey, look, if you do it, we're going to catch you and we're going to make an example out of you. John McAfee, who we all know was the antivirus guy, he was also laundering millions of dollars through cryptocurrency nominees. We have folks doing, pyramid schemes with cryptocurrency. So we're seeing that with the OneCoin investigation. We got Mr. Bruno Block, which I think that's a fantastic name. I can't wait to see the Oliver Stone movie on this at some point in time later on. But dealing in golden cash and crypto and shell companies. And then, of course, the IRS is going to publish that they went after these people, and they're going to put it on their website and publications as well too. They have Operation Hidden Treasure, which is supposedly the big deal for them finding out cryptocurrency and enforcing on cryptocurrency. So they're really, the IRS is getting super sophisticated with their new fraud enforcement offices. And the saying is, if you have unreported crypto, get legal advice. I mean, they're really coming in strong on this one, especially if you're doing some kind of criminal transaction. They're really trying to root those out. So hidden treasure is something I think is going to be with us for a while, and folks need to be aware of that. I know a lot of folks have had Binance, investments with Binance or crypto with Binance. Well, that, again, chain analysis, they are getting into the Binance. They're looking at it closely with the DOJ. There's suspected of money laundering. I know a lot of people have been locked out of their Binance accounts, or Binance basically kicked them out. So it's like almost impossible to get the data. Like, what do you think the data is? Can we do, some kind of recreation on the data? It's a little difficult to figure out, but that's something that's going on right now. Like I said, there is no amnesty program. I remember I underlined it for cryptocurrency, unfortunately. So, it's not really, at least not yet, a foreign financial asset. So you can't really use the streamlined filing compliance procedures. I mean, I guess you could, if you could make an argument saying that it's, reportable on the 8938 as a foreign financial asset, then maybe you have a way to get in there. But I think in order to come back into compliance, you need to speak, if you think you have a really hot button issue, talk to an attorney. If you think it's just a matter of making some amendments or some changes to your tax return, talk to a CPA if you're in the civil realm, but make sure that you speak with someone before you go out and you make a bunch of changes to your tax filings. And then record keeping, I'm going to preach this, and I know we're going over here a little bit, but I'm going to preach this hardcore. Record keeping is key. A lot of people think they're doing record keeping. They're not doing record keeping. You're not keeping track of your cost basis. You're not keeping track of your fair market value. You're not keeping track of your realized and unrealized gains. You need to keep better track of it. You need to do it on a much more regular basis. This is really, really important. It'll help you. It'll help your CPA. It'll help you in case the IRS asks questions. Please, please, please do better record keeping. If you have multiple wallets, make sure you're tracking everything, do some wallet mapping, use specific identification as your accounting method. I mean, that's really critical, as you saw on our first presentation. And then personally, people always ask me, well, Mish, what do you recommend for software? I'll say this with a little bit of a caveat. No software is perfect for crypto quite yet. I like CoinTracker. I like Legible Tax Pro. I may have a little bit more vested interest than others just because they easily integrate into our tax software. But honestly, CoinTracker, in my opinion, does a great job at mapping the multiple wallets. The caveat that I'll give, though, is that you always get to double check the data because I wouldn't say sometimes, a lot of times, we look at the end report or the end output and it's missing something or it doesn't have all the data in there. And so it makes whatever the output is, garbage in, garbage out. And you have to really, trust but verify that you're getting a good report there. And then the last thing I'll say is that, smart people are working very hard to create, softwares and programs that can really help people out in general and help broker reporting. And so TaxBit is the new big kid on the block. They're raising a ton of money, 1.3 billion, valuation. These are the guys that are going to kind of crack the crypto and make it easy for reporting on taxes and all that stuff and managing portfolios and optimizing trades. So I think that, we're seeing things being developed and we're seeing things that could come into play. But like I said, we're rushing, in my opinion, if we think we're going to have all this done and ready to go by Jan 1, 2023. I think we have to allow ourselves a little bit more time and patience. Everything in the pandemic era or post-pandemic era, however you want to classify it, in my opinion, is moving a lot slower. The cycle time takes a lot longer, almost everything that you're doing. So I just think we have to be careful and maybe give ourselves some more time in regards to that. Okay, we got a couple minutes left, and I'm going to go ahead and get some Q&A here, maybe try to address some Q&A. Let's see here. Does the minter of an NFT receive any Ethereum in exchange for minting it? I don't believe that they do. I think it's just held on the Ethereum chain or the Ethereum blockchain. I think that's all there is to it. But again, I've never minted anything. Although, I think it'd be pretty cool if I had a sports NFT with me on it, but I've never minted anything, so I'm not 100% certain on that. What are the likely reporting thresholds for under 6038? Well, a good example is $100,000 if you're married and you live inside the US, then you have to report your foreign financial assets. If you're single or unmarried, it's $50,000 in the US. If you're outside the US, it's significantly more. And you can look at the you can look at the 8938 instructions if you would like to see kind of the different thresholds. Would airline miles or similar qualify as virtual currency? I actually think that they've taken a look at airline miles and bonus rewards, and they don't classify them as cryptocurrency. They have a whole different category for those things. So I don't think that would fall into the realm of virtual currency. Although, I could see airlines and credit cards kind of getting into the crypto space and maybe kind of getting into that. So maybe a TBD on that for the future. Okay, if an individual owns crypto through US-based brokerage accounts, Robinhood and Coinbase, so quite common, people are getting on the Robinhood app, they're gaming, I'm buying the crypto, it's not a real thing, but they're creating taxable events. Are those subject to FBAR and 8938 reporting if the amounts exceed the filing thresholds? Currently not right now because those are, again, US-based, places. But again, if the Treasury proposal passes and they make all crypto foreign, then yes, it would for the future. But I think that would only start in January 1, 2023. So you'd still have some time to kind of adjust to that. Would the reporting also concern wallets held on own computers? So cold wallets, the answer would be yes, or at least under the very broad law as written. How about Japan? Well, how about Japan? Okay, classification in Japan. We can follow up with an email on that. There's a really good guide that gives kind of a summary of how each of the foreign jurisdictions, it currently looks at crypto, and we can definitely follow up with you all on that one. What would you recommend if one is out of compliance but didn't get a letter? Well, again, I think that you got to think to yourself: have I done something major to the point where I need an attorney, or is it something that maybe I'm just missing some income? Typically, if you're underreporting, 25% of your income. So it's 25% or less, I think you probably just need to see a CPA. if there's a substantial understatement, maybe 25% or more, or some kind of significantly material transaction, then you might want to hedge your bets and go see an attorney. Does a cold storage wallet have an owner assigned to it? Should it somehow be assigned an owner between husband and wife regarding the exit tax computation? It does have an owner assigned to it for purposes of the exit tax. If it's, say, joint owners, then you would split between the two. Otherwise, you would probably want to designate one or the other as the owner of it. And remember that there could be an interspousal gift there to consider as well for exit tax planning purposes. So maybe some strategy that would go into the cold wallet that you would hold there. Okay, any thoughts on the potential XRP price should they win the case against the SEC? Ooh, I think it would probably go up significantly, but I don't think anyone's won. I think the SEC is undefeated as of this moment right now. Saw a really good presentation actually on that the other day where it went through kind of all the SEC cases, and it sounds to me like the SEC's got the high ground there. So it would be huge if they did win that case though. All right, does the new legislation apply to crypto stocks such as Coinbase Inc.? The new legislation applies to all that stuff. I mean, it's very broad. It's very sweeping. It's got a large, and that's why those senators who are obviously being catered to by the lobbyists are trying to get exclusions or a more specific definition there, because they don't want to see some folks be included within that reporting. How does one get a copy of today's presentation? And will be on YouTube later? Yes, all of our webinars are put on our YouTube channel, which will go up at some point in time. We have a lot of training going on right now at the Wolf Group, so a lot of activity this week. So give our support team a little bit of time because they need to catch up from all the activities that we're doing this week. But I would assume that this may go up sometime next week. And then what will happen is also a copy of the presentation will go out to everybody that's on the list. Okay, well, we're now really over. I'm sorry to keep you guys. It's a pet peeve of mine to go over time. But I hope you guys enjoyed the presentation. If anyone has any additional questions, please feel free to contact us. There's the contact info. I work well, I think both Van and I would work well over email. So please shoot us an email and let us know if you have any questions. And it was a pleasure speaking with all of you or doing the presentation for you guys today. Thanks.